So today we're diving into the latest financial report from Beauty Garage, a huge supplier for salons and spas. And wow, their recent numbers tell a really interesting story, one that shines a light on a classic challenge that a lot of fast-growing companies run into. Which leads us to this classic business puzzle. How on earth can a company be selling more stuff than ever before, but actually end up making less money? That's the mystery we're going to unpack today. Okay, so just look at these numbers. They lay out the whole problem crystal clear. The top line, sales, is up 13.7%. That's awesome, right? But then you look at the next two lines and whoa, they're going in the complete opposite direction. Operating profit, which is all about how much money they make from their main business, is down almost 17%. And net profit, the final bottom line, that's down nearly 19%. All right, so here's how we're going to break this whole thing down. First, we'll dig into that big paradox. Then, we'll check out their amazing growth story. And after that, we'll solve the profitability puzzle. We'll see how this is all changing their financial footing. And finally, look at how they plan to get through these growing pains. Okay, first up, let's really get to the heart of this big contradiction. It's like a tale of two completely different stories happening inside the same company at the very same time. This slide just nails the core problem. On one side, the business is totally winning. You've got more customers, more orders, more everything. But on the other side, for all that extra activity, they're actually keeping less of the money as profit. So they're getting bigger, but they're also getting less efficient. The big question is, why? Okay, now for the good news. Because before we figure out what's up with the profits, you got to see just how well their sales are doing. It's actually really impressive. And check this out, this isn't just one part of the business getting lucky. The growth is happening literally everywhere. Their main business, merchandise, is up over 11%. But I mean, look at store design and solutions. We're talking a massive 28% and 26% jump. That's huge. It really shows their whole model is clicking with customers. So let's be super clear. There is no problem with demand here. The company's products are hotter than ever. Salons can't get enough of what they're selling. And honestly, this strong growth all over the place is what makes that drop in profit so confusing. It just goes to show how easy it is for great sales to hide some serious operational problems bubbling just under the surface. All right, so we know sales are absolutely booming. Now it's time to put on our detective hats and find out where all that profit went. Right, this is the million-dollar question. When you've got all this cash coming in the front door, how is it vanishing before it hits the bank account? Well, lucky for us, the company points us right to the smoking gun in their own report. And there it is. The culprit isn't sales, it's not marketing, it's logistics. The plumbing of the company, basically. They're trying to pull off this huge upgrade to a new warehouse, but it's been a mess of delays and technical glitches. And that has created a super expensive bottleneck right in the heart of their business. You know, the best way to wrap your head around this is the moving house analogy. Imagine you're moving into a bigger, way better house, but the moving truck breaks down, the whole thing gets delayed by weeks. And the whole time you're stuck paying the mortgage on the new place and the rent on the old one. You're paying for everything twice. That is exactly what Beauty Garage is doing with its warehouses right now, and it is burning through cash. Okay, so a massive, super expensive project like this new logistics center, it doesn't just hit your daily costs. It actually changes the entire financial DNA of the company, and we can see the proof right on their balance sheet. Just look at this. On the one side, their tangible fixed assets, buildings, machinery, have more than quadrupled. That's the new logistics center showing up on the books. And how'd they pay for it? Well, look at the other side. Their long-term debt shot up by almost the exact same amount. So what you're seeing here is a massive bet on the future. They took on a whole bunch of debt to build this brand new state-of-the-art facility. It's a textbook case of short-term pain, this messy, expensive move, for what they hope is a huge long-term gain in efficiency. This is a hurdle pretty much any company selling physical stuff has to clear when they try to scale up. Okay, so we know the problem, we know why it's happening. The final piece of the puzzle is what now? How does Beauty Garage get through these growing pains and actually fix this? Well, get this. The company is still forecasting an operating profit of over 1.5 billion yen for the whole year. Now, to hit that number after the rough start they've had, man, they are going to have to nail their plan perfectly. So, what's the plan? Their path forward is actually super clear. There's no magic to it. First, they got to fix those machine problems at the new place. Then they need to finish the move and shut down that old, clunky warehouse for good. Once they finally stop paying for 2 logistics centers at the same time, all those extra costs should just disappear, and their profits can finally catch up with their incredible sales growth. And so that really is the final question, isn't it? The company knows exactly what the problem is, and they have a clear plan to fix it. But at the end of the day, it's all about execution. Whether they can solve this logistics puzzle over the next few months will determine if this story of amazing growth gets the profitable ending it absolutely deserves.